Usually when we talk about a market diagnosis, there's this expectation of precision, like engineering.
Right, like it's binary.
Exactly. You break your arm, the x-ray shows that jagged white line, and the doctor just points and says, there it is. That's the structural failure. Here is the exact plan to fix it.
Yeah, institutional capital usually prefers that level of diagnostic clarity. They want a specific measurable catalyst and a specific response.
Right. But then you step into the equity markets right now in March of 2026, and that diagnostic clarity completely evaporates. I mean, it is just gone.
Oh, it's totally gone.
We are looking at a tape right now that is flashing these profound systemic warnings while simultaneously punting record-breaking corporate cash flows.
It's a massive contradiction.
It really is. I mean,
Thanks.
for you listening, think back to January. 2026 started with the S&P 500 hitting an all-time high, 7,002. The momentum just seemed absolutely bulletproof.
It felt unstoppable.
But here we are in March, and we're looking at a 7.1% slide. It decisively broke the 200-day moving average. And this isn't just a standard, technical pullback.
No, definitely not.
We are watching this simultaneous three-front collision. You've got a geopolitical supply shock in the energy markets, a tectonic shift in enterprise AI, and on top of all that, a Federal Reserve leadership transition that is just aggressively repricing the entire yield curve.
And that is exactly why we are synthesizing this specific stack of research for today's deep dive. Because you really have to look at all of it.
Right, we've got a huge stack today.
We do. We're looking at forward earnings outlooks from Goldman Sachs, Morgan Stanley, and FactSet. And then we're cross-referencing those with technical and credit data from Lance Robertson ONDA.
Which is crucial, yeah.
And layering on fundamental sector analyses from S&P Global and the Motley Fool. Because, look, if you only look at FactSet's earnings projections, you're just buying the dip blindly, right? Assuming the macro environment is static.
Yeah, you're missing the whole picture.
Exactly. And if you only look at Lance Roberts' credit spreads, you're liquidating your entire portfolio and hiding in short-duration paper.
Panic selling everything.
Right. You have to synthesize the macro, the micro, the technicals, and the fundamentals to find the actual signal here.
And for you listening, we know exactly what your objective is. You want to cut through the reactive noise. You're tracking these same indicators, looking at your own allocations, and trying to determine if the structural integrity of this market is actually compromised.
Have we hit a local bottom, or is this the start of a severe contraction?
Exactly. What are the actual long-term impacts of the infrastructure disruptions in the Middle East? And ultimately, looking at the risk-reward matrix right now, should the average investor buy the dip, sell, or hold? Okay, let's unpack this.
Let's do it.
Starting with the immediate catalyst that interrupted all these algorithmic trading models. We need to look at the physical supply chain overriding the financial narrative, the geopolitical shock in the energy sector.
Yeah, that was the initial fracture point. Yeah. What's really crucial to understand here is that the equity market had almost entirely priced out geopolitical risk premiums by late 2025.
Right, everyone thought it was fine.
The consensus was just that conflicts would remain localized. But the ONDA and Forex Solutions reports highlight an escalation involving Iran that forces a complete recalibration of that risk premium across every single asset class.
Let's dig into the operational specifics here, because the headline risk is translating directly into logistical paralysis. We are looking at the U.S. Army's reported strategic operational plan to secure Karg Island.
Which is massive.
It is. For those who don't know, Karg Island isn't just a piece of land. It is the terminal that handles roughly 90% of Iran's crude exports. The stated strategic objective is to apply maximum pressure to guarantee the reopening of the Strait of Hormuz.
And when you look at maritime logistics, the Strait of Hormuz is the single most critical transit choke point for global hydrocarbon supplies.
Yeah, we're talking about roughly 20% of global daily oil consumption relying on that specific waterway.
It's the ultimate systemic bottleneck. You have millions of barrels a day moving through a corridor that is only 21 miles wide at its narrowest point.
It's incredible.
When the operational integrity of that strait is compromised, the disruption doesn't just affect regional pricing. It immediately alters the routing matrix for very large crude carriers globally.
The VLCCs, right?
Right. Insurance premiums for maritime transit in the Persian Gulf just skyrocket. Ton-mile demand structurally increases because vessels are forced to take longer alternative routes. And the spot market for crude tightens overnight.
And we need to be very clear here for you listening. When we discuss the incoming administration's strategy or President Trump's pledge to intervene militarily, we are maintaining strict neutrality.
Absolutely.
We are merely reporting the contents of the ONDA report and the market's reaction. We are not endorsing or criticizing the political figures or policies. We're just looking at the math.
Just the data.
Yeah.
The capital markets, they don't possess a political ideology. They are ruthless discounting machines. They process probabilities, operational timelines, and the cost of capital. Initially, there was algorithmic buying based on hopes for a swift tactical resolution.
But that faded fast.
Really fast. Military logistics analysts cited by ONDA suggest that securing an asset with the footprint of Karg Island requires extensive boots on the ground, extended supply lines, and potentially months of sustained operations.
So when the probability of a swift resolution evaporated, the market aggressively repriced a sustained conflict.
Yeah, the ONDA report notes that the risk premium immediately embedded itself into the forward curve for crude. The backwardation in the oil futures market steepened aggressively, which just means there's intense immediate demand and huge fear of future scarcity.
And the mathematical reality has been stark. Brent crude decisively closed above $108 a barrel. The Dow dropped 1,200 points in early March trading, just reflecting the sudden compression in industrial margins.
And looking at the S&P 500, Lance Roberts points out that the 7.1% slide decisively broke below the 200-day moving average.
Which is a huge technical trigger.
It is. The 200 DMA isn't just some arbitrary line on a chart. It dictates the behavior of commodity trading advisors, systemic trend-following funds, risk parity strategies.
Right.
When you break that level and fail to reclaim it, it mechanically triggers these funds to degross their portfolios. It creates forced selling, irrespective of underlying company fundamentals.
But that mechanical selling pressure is really just a secondary effect, right?
Yeah.
Because the primary overriding concern bleeding into the equity markets stems from the Federal Reserve. We are going through this market transition precisely during a major leadership shift.
War shock.
Exactly. Jerome Powell is out, and Kevin Warsh is assuming the chairmanship, and institutional desks are universally calling this the Warsh shock.
Warsh brings a profoundly different philosophical approach to monetary policy. He is historically viewed as an aggressive inflation hawk.
Very hawkish.
His track record suggests he's willing to maintain restrictive monetary conditions, even at the expense of equity valuations or near-term labor market stability, just to ensure price stability.
And he is taking the helm exactly as this crude oil shock hits the tape. The timing is unbelievable.
It really is. We also have to incorporate the commentary from Fed Governor Waller. In his first post-FOMC interview of the year, he explicitly warned that a sustained conflict in the Middle East and the resulting energy supply constraints could disanchor inflation expectations.
I want to look closely at the yield curve reaction here because this is where the macroeconomic thesis really gets tested. We've seen oil shocks before, the 70s, the early 2000s, 2022. But look at the Treasury market right now. The U.S. two-year Treasury yield just exploded to 3.90%.
While the Fed funds rate is at 3.75.
Right. So why is this specific disruption sending yields surging? Think of the broader economy like an internal combustion engine. Oil is the physical fuel required for output, but the Treasury yields act as the engine's temperature gauge. Right now, that dashboard gauge is flashing red. Why is the bond market pricing in a temperature spike when the Fed funds rate is already restrictive?
That engine analogy perfectly captures it. The engine is redlining because the primary cooling mechanism, the Federal Reserve's capacity to ease monetary conditions, has been disabled by the physical commodity market.
Wow, disabled.
Yeah. Let's look at the assumptions behind that big January rally. The S&P hitting 7,002 was predicated on this flawless, immaculate disinflation narrative.
Right, soft landing, everything is perfect.
The market had priced in steady, robust GDP growth alongside aggressive rate cuts throughout 2026.
So the assumption was that the cost of capital would structurally decline, which expands equity multiples.
Precisely. But when Brent crude anchors itself above $108 a barrel, the fundamental input cost for the entire global supply chain resets higher. It impacts aviation fuel, maritime bunker fuel, fertilizers, basic logistics.
Everything.
Everything. The transmission mechanism from raw commodities to consumer prices is direct. Lance Roberts highlights this. February's producer price index jumped 0.7% month over month. That is the hottest pipeline inflation print since July 2025.
That wholesale pricing pressure will inevitably compress corporate margins or be passed through to the consumer. It creates a stagflationary vice.
Exactly. What's fascinating here is the absolute policy paralysis it creates.
The Fed is trapped.
Totally trapped. If the consumer begins to fracture under the weight of higher borrowing costs, the traditional central bank playbook is to cut rates to stimulate aggregate demand. But Kevin Warsh cannot deploy that playbook if energy constraints are driving headline inflation back toward 3.5 or 4%.
Right, because easing financial conditions during a commodity supply shock risks igniting a 1970s-style wage price spiral.
The bond vigilantes recognize this instantly. They look at the data and conclude that the Fed cannot ease. In fact, the probability shifts toward holding rates higher for significantly longer or even hiking.
Which is why the two-year Treasury gapped up to 3.90%.
Exactly. Investors are demanding immediate compensation for the risk of structurally higher, sticky inflation. And for the corporate sector, this means refinancing debt becomes significantly more expensive, precisely when operating leverage might be peaking.
Okay, so if capital remains this expensive and the macro environment is tightening like a vice, you have to look at who is most vulnerable to a sudden liquidity contraction.
Right, the glass jaw of the market.
Exactly. It reveals the structural fragility underlying those January highs. The index didn't just correct, it cracked abruptly. And the vulnerability wasn't distributed evenly, it was heavily concentrated. Which leads us into the architectural flaws of the S&P 500 and this paradigm shift analysts are calling the SaaSpocalypse.
Yeah, we really have to analyze the fundamental construction of the index itself. The S&P 500 is market capitalization weighted. As companies appreciate in value, their proportional influence on the broader index increases.
Right.
Over the past 3 years, the sheer magnitude of capital flows directed into AI narratives created a distortion in market breadth that is just historically unprecedented.
The Financial Content Report quantifies this perfectly.
Yeah.
They released the 45% fragility analysis. By mid-March 2026, the top 20 equities in the S&P 500 accounted for nearly 45% of the total index weighting.
It's wild.
Stop and consider the mathematical reality of that for a second. Out of 500 of the most prominent corporations in the U.S., a mere 20 of them dictate almost half of the index's variance.
And the report emphasizes that this degree of concentration aggressively surpasses the previous historical peak from the dot-com bubble in 2000.
Which is terrifying.
It is. And when you evaluate the valuation premiums assigned to that concentrated cohort, you encounter metrics that suggest a complete suspension of risk assessment. The Motley Fool highlights the Shiller KP ratio.
The cyclically adjusted price-to-earnings ratio.
Right. By analyzing a trailing 10-year average of inflation-adjusted earnings, the KP ratio filters out near-term cyclical volatility. The S&P 500's KP ratio just breached 40.
Hitting 40. We haven't seen that since the absolute peak of the dot-com bubble, and before that, 1929. That tells me the market is priced for absolute perfection, with zero margin for operational error.
It implies that the terminal growth rates modeled into these equities required flawless execution in perpetuity. Any deviation would result in severe multiple compression.
And that deviation materialized in February 2026, initiated by the exact technological catalyst that was supposed to guarantee the growth.
The SaaSpocalypse.
Let's dive into this, because the catalyst wasn't a regulatory crackdown or a semiconductor shortage. According to the research, it was the commercial deployment of Anthropic's Claude Cowork, specifically the Opus 4.6 architecture.
Yeah, this is a massive leap. We are no longer discussing large language models functioning as advanced autocomplete. The technical reports define Opus 4.6 as agentic AI.
Wait, so it's not just a chatbot assistant anymore?
No, it possesses the capability to autonomously navigate, execute, and verify complex multi-step enterprise workflows without human intervention. We are talking about an AI layer that can initiate a compliance audit, query disparate SQL databases, reconcile financial ledgers, draft the regulatory filings, and route them for final approval.
On its own.
Completely autonomously via API integrations.
What's fascinating here is the abrupt inversion of the enterprise software thesis. Because for the past 3 years, the consensus narrative was that AI would serve as an embedded co-pilot.
Right, the helper.
SaaS companies would integrate these models into their platforms and enforce aggressive pricing power, adding a $30 or $40 monthly premium per user. It was supposed to be a massive high-margin revenue expansion.
But the agentic architecture of Claude 4.6 obliterates the economic foundation of that model. Right. If the AI agent is capable of executing the workflow autonomously, The enterprise no longer requires the human operator to sit in front of the software dashboard.
And more critically for the equity markets, they don't require the software license for that human operator either.
Exactly. The core economic engine of the SaaS industry has been the per-seat subscription model. Anthropic's release renders that pricing structure functionally obsolete for vast swaths of middle office operations.
If a company can reduce a 50-person procurement department down to 5 analysts overseeing an array of autonomous agents, they don't just eliminate 45 salaries, they cancel 45 licenses for Salesforce, ServiceNow, Workday, Atlassian.
And the market recognized this disintermediation threat instantaneously. The terminal value calculations for these SaaS platforms collapsed because their projected growth rates for user acquisition suddenly inverted.
Let's review the damage across the megacaps because it is severe. Microsoft, which positioned itself as the foundational layer of AI integration, is down 20%.
And 20% on Microsoft is staggering.
It is. The analyst notes specifically cite margin fatigue. Institutional investors are auditing the tens of billions of dollars Microsoft has allocated to capital expenditures, securing power agreements, hoarding NVIDIA silicon, and they're concluding that the return on invested capital is structurally misaligned with the timeline.
The infrastructure spend is front-loaded and massive, while the software revenue realization is being cannibalized by these autonomous API-driven agents.
And the derivative impact on pure-play SaaS is even more pronounced. Salesforce, ticker CRM, and ServiceNow, ticker NWW, are experiencing aggressive multiple compression as analysts revise revenue estimates downward.
Plus, the consumer-facing tech components are offering no buoyancy. Amazon is down 11.3% year-to-date, heavily impacted by AWS growth concerns. And Tesla has contracted 12.7% amid margin compression and increased capital costs.
When you map this price action back to that 45% fragility metric we talked about, the mechanical feedback loop becomes so apparent. As Microsoft, Amazon, Tesla, and these SaaS giants endure double-digit contractions, their sheer market cap forces the broader index down.
Passive index funds are forced to indiscriminately sell the broader market to match the index weighting. The architecture ensures that the collapse of the top tier generates a systemic downdraft.
But if the top 20 stocks are dragging us down, what about the other 480? Are they drowning too, or is there a lifeboat?
That is the defining debate on Wall Street right now. We have to critically evaluate the underlying breadth of this downdraft. Is this a targeted, localized deflation of a specific tech multiple, or is it symptomatic of a broader macroeconomic deterioration?
Right, the big question. Are we witnessing the leading indicators of a systemic liquidity event? Which brings us to the core anxiety for a lot of you listening. Is this 2008 all over again?
Let's aggressively stress test both the bear case and the bull case here.
Let's start with the bear case, the systemic risks.
The bearish framework requires a close look at the credit markets. Equities often price in optimistic forward multiples, but fixed income and private credit are hyper-focused on cash flow solvency and default risk. Lance Roberts has published a highly detailed analysis focusing on credit default swap spreads, or CDX spreads.
Okay, let's explain what a CDX spread is really quickly for the listener. It's essentially the premium that lenders demand to extend credit to riskier corporate borrowers compared to the risk-free treasury rate.
Exactly. And Lance Roberts is flagging a major divergence. His data shows that CDX spreads just hit a 9-month high in early March. But the critical variable isn't just the absolute level, it's the decoupling.
These spreads were widening steadily throughout January and February, while the S&P 500 was touching 7,000.
Yes. And we saw this exact decoupling in late 2007 before the great financial crisis. We saw it in 2015 and again in early 2022. The equity markets were celebrating multiple expansion, while the credit markets were quietly pricing in a wave of forward defaults.
The mechanism here is the maturity wall, right?
Yes. Throughout the zero interest rate environment, corporations termed out their debt at incredibly low yields. But a massive tranche of that corporate debt is scheduled to mature in 2026 and 2027.
So if a mid-cap industrial firm has to roll over its paper right now, it isn't just facing the elevated 3.90% risk-free rate. It's facing that rate plus the blowout in the credit spread.
Their weighted average cost of capital is doubling or tripling overnight, and the behavioral response is immediate. They preserve cash flow by slashing capex, reducing headcount, and canceling enterprise software contracts,
Which creates a reflexive loop where credit illiquidity translates directly into an earnings recession. Roberts notes that when this specific divergence triggers a breakdown below the 200 DMA, the S&P experiences a historical average maximum drawdown of 16.5%.
which would project a capitulation target in the 5,800 to 6,000 range. a profound contraction in aggregate wealth.
So the bear case is that the Fed is paralyzed by 108 oil, credit spreads are choking off refinancing, and the tech megacaps are undergoing a deflationary shift.
A hard landing.
Right. But then we pivot to the bull case. The institutional projections from FactSet, Goldman Sachs, and Morgan Stanley. Their models completely reject the hard landing thesis.
They do. They're looking at the exact same yield curve and geopolitical data, yet they explicitly advise clients to view this as a localized repricing event.
The bullish argument is anchored entirely in realized tangible corporate cash flows. FactSet reports that Q1 2026 earnings growth is actually a robust 12.5%.
If that materializes, it marks the sixth consecutive quarter of double-digit earnings expansion. Top-line revenues are projected to expand by 9.6%.
That's massive. Corporations are actually generating massive amounts of free cash flow. This isn't theoretical. This is tangible cash hitting the balance sheet.
And that is exactly why Goldman and Morgan Stanley remain steadfast. They still forecast the S&P hitting 7,600 to 7,800 by year-end. Goldman is modeling U.S. GDP growth of 2.6% for 2026. Aggregate demand remains highly resilient.
We also have to talk about the fiscal tailwinds. And again, maintaining strict political neutrality here, we're just looking at the math of the One Big Beautiful Bill Act, or OBBBA.
Right. Morgan Stanley heavily emphasizes the delayed stimulative effects of OBBA. The legislation injects roughly $100 billion in direct tax refunds into the consumer economy right now in the first half of 2026.
It acts as a highly effective bridge loan, sustaining aggregate consumer demand even as credit card and auto loan rates remain restrictive.
And on the corporate side, it engineers a $129 billion reduction in corporate tax liabilities modeled through 2026 and 2027. This directly bolsters free cash flow, providing the exact liquidity cushion needed to offset the tightening credit conditions Lance Roberts flagged.
So companies can self-fund CapEx or sustain dividends without needing the hostile credit markets. Fiscal dominance is effectively neutralizing the restrictive monetary policy.
If we connect this to the bigger picture, we are observing a historic tug-of-war. On one side, a concentrated, overvalued tech cohort undergoing a structural reset and a paralyzed Fed. On the other side, a robust fiscal impulse and exceptional corporate operating margins providing a floor for the economy.
So the volatility reflects a reassessment of risk, not a breakdown in underlying economic fundamentals.
Exactly. It's a violent, necessary reallocation of capital from overcrowded narrative trades into fundamentally sound cash-flowing assets.
Which naturally forces us to examine where that capital is flowing,
Right.
translating this macro tug-of-war into specific sectors and tickers. What is in the green and what is in the red in 2026?
Well, the most pronounced beneficiary right now is the energy sector. Energy is the clear winner.
Makes sense with oil above $108.
Exactly. Their break-even costs were optimized for a $65 to $70 environment. At $108, the delta drops directly to bottom-line free cash flow. The Trefis and financial content data highlight the legacy supermajors. ExxonMobil, ticker XOM, and Chevron, ticker CVX.
Both surging over 20% year-to-date, hitting 52-week highs.
They function as the ultimate safe harbor because they control tangible physical assets that scale with inflation. Capital is abandoning abstract software models and seeking localized yield.
Well, it's not just the mega caps, right? Zacks Investment Research flags Diamondback Energy, ticker FANG, for high-margin Permian Basin exposure, and a really specific maritime logistics play. International Seaways, ticker INSW.
International Seaways is fascinating. They operate oil tankers. With the Strait of Hormuz compromised, transit times increase dramatically. This removes vessel capacity from the global fleet, tightening utilization. The spot rates for their fleet expand exponentially.
And we're seeing parallel strength in gold.
Yeah.
Gold is hitting record highs.
Yeah, driven by institutional hedging against geopolitical risks and inflation. Margin expansion for mining operators like Newmont, ticker NEM, is profound.
And then there's what Goldman calls the Great Rotation, or the S&P 493 catch-up.
Right, capital rotating out of the Magnificent Seven into cyclical industrials and legacy financials. Caterpillar, ticker CAT, is capturing bids as global infrastructure capex increases. JP Morgan Chase, ticker JPM, is thriving due to a structurally higher yield curve expanding their net interest margin.
Here's where it gets really interesting, though. We have to look at the mechanical plumbing of the market, specifically the March 20th triple witching and the S&P 500 rebalancing.
A massive liquidity event.
Huge. Passive index funds are legally mandated to replicate the index perfectly. So look at exactly who the S&P committee is adding. They are heavily buying into the AI industrial complex. They're adding Vertiv Holdings, ticker VRT, which engineers high-density liquid cooling for data centers.
They're also adding Lumentum, ticker LEET, for optical networking, and Coherent, ticker COHR.
The irony here is so profound. AI software, the SaaS platforms, are crashing because of agentic AI, but the physical pipes and coolers required to process that AI are being fast-tracked into the S&P 500.
The market has transitioned from the theoretical software phase to the heavy industrial deployment phase. Classic picks and shovels dynamic.
But every rotation requires a funding source. Where's the capital coming from?
Consumer discretionary is getting hammered. Home Depot, ticker HD, and Lowe's, ticker LOW, are experiencing sustained drawdowns.
Because the Fed is paralyzed, anchoring mortgage rates near 7%, so existing home sales are frozen.
Exactly. No large ticket remodeling projects. And retailers like Target, ticker TGT, and Walmart, ticker WMT, are struggling to defend operating margins against sticky wage inflation. Target is actually getting removed from the S&P 100 index during this March rebalance.
Wow, and looking at the worst starts for 2026, Cleveland Cliffs, ticker CLF, down 26%, UFP Industries, ticker UFPI, down 15%, Hexcel, ticker HXL, down 17%.
The market is ruthlessly punishing speculative growth and highly leveraged cyclicality while rewarding tangible cash flows and essential physical infrastructure.
So, bringing this all down to earth for you listening, you're trying to figure out your own portfolio strategy. Should the average investor panic?
The consensus from the sources, Lance Roberts, U.S. Bank, Morgan Stanley, is definitively not yet.
Not yet. Lance Roberts says patience is a position. It is a shopping list market, not a buy-everything market.
That distinction is paramount. The current environment requires transitioning from aggressive offense to highly selective defense, accumulating quality at predefined levels. Roberts advises maintaining cash reserves and waiting for the S&P to hit structural support, like the 6,400 or 6,300 range, before deploying capital.
And while you wait, there is a massive dividend safety net. S&P Global projects that aggregate U.S. corporate dividends will expand by 6.5% in 2026. Microsoft is down 20%, but they are paying out $27.7 billion in hard cash dividends this year.
Over 80% of dividend-paying S&P constituents are increasing their payouts. This steady stream of liquidity provides a massive buffer against price depreciation.
So what does this all mean for someone sitting on cash right now?
If we connect this to the bigger picture, the current volatility is the ultimate vindication of structural diversification. The dual shock of Carg Island and Claude 4.6 demonstrates why you need exposure across uncorrelated sectors: energy, financials, the AI industrial complex, and blue-chip dividend payers.
Because the underlying earnings of the S&P 500, that 12.5% growth, just don't currently support a 2008 level panic.
Yeah.
Disciplined holding and selective buying are the most rational path.
Precisely. Until the macroeconomic data fundamentally fractures, the market is engaged in a necessary repricing of risk premiums, not forecasting an apocalyptic contraction.
So to wrap up the massive ground we've covered today, we looked at the Carg Island oil shock anchoring crude at $108. We dissected the SaaSpocalypse, shifting tech dominance away from the per-seat model due to Claude 4.6. We weighed the CDX spread warning signs against strong corporate earnings and discussed the shopping list mentality for investors.
But before we go, there is a really fascinating question to ponder.
Let's hear it.
If agentic AI like Claude 4.6 is starting to replace the very software companies that champion the AI boom, are we witnessing the technology sector eating itself?
That's a great question.
And if so, will the true winners of the 2026 market simply be the legacy companies like oil, banks, and industrials who use this cheap AI to maximize their own profits at big tech expense?
The ultimate irony. The legacy companies win the AI race by just using it to cut their overhead. Really provocative thought to end on. Thank you so much for joining us for this deep dive. The market moves incredibly fast, but being well-informed, looking at the actual data rather than the noise, is the best investment you can make. We will catch you on the next one.